ETF Edge, your go-to place for everything exchange-traded funds. I'm Frank Holland in for Mr. Bob Pisani. Wall Street is climbing a wall of worry on top of mounting fears over runaway inflation and a dramatically more hawkish Fed. Geopolitical tensions are also adding just a brand new layer of macro uncertainty to the mix for the global markets. In a flight to safety, gold prices, they shot up to the highest levels we've seen since just before Thanksgiving, while crude prices are hovering right around 80-year highs. Commodity ETFs suffered net redemptions in 2021, but they've already racked up more than $6 billion in inflows this year. So how does this latest turmoil factor into the commodities equation? Joining us now is Tom Lydon, CEO of ETF Trends, along with John Davey, founder and CIO of Astoria Portfolio Advisors. Tom, we're going to kick it off with you. ETFs are still on pace to hit over $700 billion in 2022. Pretty tough to top that record year that we had just in 2021. But why do inflows into equity funds? Why do they still continue unabated despite all the uncertainty out there?
Well, you're right, Frank. It would be tough to beat that $1 trillion mark that we almost hit last year, but we're on pace for almost $500 billion a month. A couple changes, though. Inflation and the threat of rising interest rates have really scared off investors. When you look at the average financial advisor, and we're surveying them every week, they've had major construction changes in their portfolios. What they're doing is paring back the traditional 60-40 and moving more out of fixed income and into areas like alternative income strategies, like dividends or even options overlay strategies. And then most importantly, more and more advisors are allocating, as you say, to commodities. We're seeing commodities shoot up all over the place, and there's some great diversified commodity options that are there. Look, rising rates can be very, very detrimental to client portfolios. Advisors understand that. Investors haven't seen that in a long period of time, but they're voting with their feet.
Absolutely. John, over to you. How would you say that investors, how should they cope with all this elevated risk?
Well, I think, largely speaking, commodities make a lot of sense because they are hedged against inflation. We didn't have much inflation for the last 10 years. CPI is now 40-year highs. So tickers like PDBC, BCI, these are broad-based commodity ETFs that we utilize at Astoria Advisors. There's really three reasons why you want to own commodities. One, it's a hedge against inflation. So these tickers that I just mentioned, they're up 11% year to date. S&P is down 7%. Bonds are down 3%. So you see that right then and there that they're serving their place in the portfolio to provide inflation protection. But there's two other attributes. One is when you have geopolitical risk and tension, you tend to see oil go up, you tend to see gold go up, and that's different from stocks, right? When stocks go down, and this year actually bonds have been going down. So the technical term is that they provide positive skewness. Stocks have negative skewness. So it's worth having in the portfolio just to diversify your risk attributes. And then the third reason, which is more unique, is that they actually provide right now a positive benefit. There's no cost to owning these commodities. And this has to do about how commodity futures roll. Right now, you're getting a benefit. Years in the past, they used to have a cost. So those three attributes, we like to have commodities in our portfolios at Astoria Advisors.
All right, digging a little bit deeper into the reflation trade. Reopening ETFs, they're red hot again, powered by renewed flows into travel and leisure ETFs. This month, as COVID restrictions ease all across the globe, that reopening narrative is beginning to really regain some steam. Airline ETFs, hotel ETFs, and leisure and entertainment names like Invesco Dynamic Leisure and entertainment ETF ticker PEJ, they've all led the charge higher, up 5 to 10% just over the past week. And as rates rise, investors are offloading broad swaths of bond ETFs here in the U.S., but the global fixed income is getting just a bit more of a bid. Tom, back over to you again. What are the flows telling us about how investors are really feeling right now? Is it finally the cyclicals time to shine?
Yeah, you're right on the reflation trade. As things start to warm up, people are mandated less to wear masks. That's really good. It's very optimistic. But at the same time, what we're seeing is diversification. It's nice to pick up some of these thematic strategies, like I say, PEJ, or the airlines ETF, JETS, JETS. But I think the key thing here is it's diversification. As you point out with fixed income, we're seeing rising interest rates and the threat of rising interest rates here in the U.S., Frank. But overseas, not all developed countries are suffering from that threat of rising rates. So people are diversifying to areas like emerging markets, where it's not only an opportunity to get a better yield, and you're also not going to be threatened by central banks necessarily being as hawkish as we are here in the U.S. Also, there's a currency play here. If we're in a situation where some of these foreign currencies may actually do better than the U.S. dollar, there's another form of diversification.
Yeah, certainly. John, over to you. You run the Astoria inflation-sensitive ETF. The ticker is PPI. That's up nearly 6% year to date. Tell us what you're seeing here.
So about 2 years ago, I actually came on ETF Edge in June of 2020. And at the point, at that point in time, the 10-year was at 30 basis points. There was a ton of liquidity being provided to the market. I know from the data and the evidence and history of managing money that, typically after a recession, you get this, wave higher in value, cyclicals, inflation-sensitive stocks. So, about a year and a half ago, we put together a formal inflation-sensitive model portfolio. It's basically 10 instruments to kind of try and hedge against inflation, banks, energies, industrials. A couple months ago, we went ahead and launched a formal ETF. So ticker PPI, which is a play in the producer price index, it gives you exposure to banks, energy, industrial, materials, those four sectors. The data shows that historically those four sectors do the best when you have rising inflation. We do also add commodities in there. We like commodities, as we just talked about, and all the attributes that they provide. What I would say is that, Tom mentioned he surveys advisors. We serve as an outsourced CIO for other financial advisors. We actually have the evidence. We see these portfolios, on the margin. Yes, are they tilting more towards, commodities and things like tips? Yes, but the lion's share of the money is still in very deflationary sectors, and still a lot of growth bias, a lot of technology bias. So we kind of have been saying add 5-10% of your portfolio towards inflationary type ETFs. Obviously we like our ticker, but there's other instruments out there. What I would say is that from 1989 to 2000, you had this big bull market in growth stocks. And then after the dot-com bubble, you had a 7-year run where value stocks outperformed. Then from the great financial crisis till about 2020, you had, a massive run in growth stocks. I think this value cyclical inflation trade is still in the early stages. If I'm a financial advisor, I would really be looking at your portfolio and say, what can you do on the margin to hedge against inflation? CPI is, 7%. When I look around the world, I see inflation more like 15%, even higher, when I look at costs of goods and, grocery shop and home prices. So I would really start to be more active in your portfolio.
Yeah. And Frank, one thing just to add on really quick. A lot of folks feel that a way to protect yourself is via gold. Gold traditionally has been a great protector against inflation, but it's been one of the worst performing commodities during this inflationary period. So as John's pointing out, it's important to be diversified among a whole basket of different commodities, and they've done that in their ETF PPI.
Yeah, really interesting stuff, guys. There, obviously, inflation having a big impact on the markets and your investment strategy overall. So finally, we're talking healthy heart investing today in light of both Valentine's Day, of course, and American Heart Month, raising awareness for the importance of cardiovascular health. The IQ Healthy Hearts ETF, powered by Index IQ, sees a portion of fees go towards supporting the American Heart Association's crucial fight against heart disease. Wendy Wong joins us now to tell us much more. She's the head of Sustainable Investment Partnerships at New York Life Investments. Hey there, Wendy.
Hello.
So, Wendy, the Heart ETF relies on a thematic ESG approach that really focuses on companies that help prevent heart disease and provide cutting-edge treatment for those diseases. Can you tell us a little bit more about this ETF?
Yeah, sure. Thank you. The IQ Healthy Hearts ETF is designed to help investors do well while doing good. And let me explain that a little bit more. On doing well for investors, heart is made up of companies that are treating and preventing heart disease. And then for the doing good, New York Life Investments, as you mentioned, makes an ongoing contribution from a portion of hearts management fees to the American Heart Association. American Heart Association uses this to support its social impact fund, which addresses health inequalities in under-resourced communities. And we see it's making an impact. Our support of the Social Impact Fund has accelerated its growth by nearly 3 times, allowing Social Impact Fund to increase its support from 33 investees in only 5 cities to 88 investees in 15.
Very interesting. Very interesting. Tom, over to you. How do you see an ETF like this playing out in the ESG space?
You couldn't find a better example, Frank. I mean, there's not a family in the U.S. that has not been negatively affected by heart disease. And rather than just writing a check to the American Heart Association, you can actually help your family invest and actually keep in touch with what's going on with all the good work that's being done in this space. And by doing that, you can appreciate your portfolio, and also a portion of that goes to the American Heart Association. Part of the revenues, and this tens of millions of dollars every year that are donated from New York Life over to the American Heart Association. What a better example to make sure that we're not only doing right, but feeling good about it at the same time, and maybe learning how we can help our family do a better job of staying healthy.
Yeah, heart healthy investing, a new wrinkle on ESG investing. That does it for us for this week's ETF Edge. I'm Frank Collin. My thanks to Wendy, Tom, and John for joining us today. And thank all of you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We're off next Monday for President's Day, but we'll see you on Wednesday. Same time, same place. Have a great week.
Seas of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.